Welcome to The Savvy Investor. Each week, The Savvy Investor helps viewers just like you create and grow wealth, protect and preserve it, and distribute it in the most tax-efficient manner while alive and after you passed. Our goal is to make you a better informed investor that hopefully leads to better results, but certainly less risk along the way. You can have financial security in any economy. Today is the day you can take control of your financial future and eliminate worry about your retirement forever. And now, The Savvy Investor, with your host, Michael Canet.
You've worked hard all your life to get to this point, and the time has finally arrived. You're ready to retire. But the question is, how are you going to create that sound income stream that you and your spouse need during retirement? Well, this is a fundamental change in your life. It's a fundamental different approach that you need to take moving forward. What you've done in the past, figuring out how to grow and create that wealth in your 401k and your IRAs and those brokerage accounts. Life is different now that you're in retirement. We need a solution to creating income that you, and if you're married, your spouse, are not going to outlive. And we're going to address that for you today. We're going to show you the steps you need to do in order to create something, an income stream for you and your spouse. Now, before we go there, I want to talk a little bit about income planning that's in the news. And today's topics, we see that from Gallup. Gallup, the pollsters, the number one concern retirees have. People think it's, what's going to happen to my kids, what's going to happen about my health, and quite frankly, what about gas prices, because they're outrageous. But really, the number one concern retirees have nowadays is, are they going to outlive their wealth? The biggest fear is, I do not want to be handing out smiley faces at Walmart down the road. So the number one concern, not outliving your money. Now, from Fidelity, they talk about safeguarding your money. And what Fidelity's talking about, and I think we're going to really delve into this today, is this thing called sequence of returns. For the longest time, people thought that they could just take a little bit of money out of their investment accounts every year, and they would be absolutely fine. Just take maybe 3 or 4 or 5% out every year, and just systematically take a withdrawal every month. The problem is, if you think about it from this perspective, if you retired in 1995, and you were taking out 3 or 4 or 5% every year, financially, you're in great shape. Even though 2001 and 2002 were horrible years in the market, you're actually fine. Conversely, if you retired in 2000, you could be in a world of trouble today and running out of money. And it has to do with taking money out of the stock market in a downward trending market and having to take more and more of your assets out each and every year to create the same amount of income. It's a great article from Fidelity. And finally, kind of along the same notes, Morningstar just came out with this report. There's this thing called Monte Carlo simulators. And a Monte Carlo simulator, the irony, of course, is that the stock market gurus tell you to leave your money in the stock market, and Monte Carlo tells you how much money you can take out every year, kind of gambling. But Monte Carlo simulators tell us that you can take out a percentage of your assets every year, and statistically, you're not supposed to run out of money. Now, the big box stores, if you follow that little green arrow or you see in the mall parking lots, the names on the side of the buildings, they have historically told you that you could take out somewhere between 3 and 5%. But Morningstar, just this January, came out with a new report and said that 2.8% is the maximum that you should take out if statistically you don't want to run out of money. So on $100,000, you can take out $233 a month. $233 a month. That's not even keeping ahead of inflation and taxes. And if you want to go to $333 a month, there's a 50% chance you're going to run out of money. And that's from Morningstar, saying you need to pay attention to how much you're taking out each and every month. We're going to take a break here, but when we come back, we're going to be joined by Cal Brown, and he is going to talk to us about income planning during your retirement years. You're watching The Savvy Investor. We'll be right back.
If you're in retirement or retiring in the next 3 to 5 years, you must read Michael Canet's best-selling book, Surviving the Perfect Storm. Best-selling author and National Quill Award winner, Michael Canet's Surviving the Perfect Storm is a must-read to prepare for your golden years. This amazing book can be yours absolutely free, but you must call 800-787-SAVVY. Supplies are limited, so be one of the first 25 callers to receive your free limited edition autographed copy of Surviving the Perfect Storm. Call 800-787-SAVVY.
Welcome back to The Savvy Investor. Today we're talking about retirement income planning. You've worked hard all your life to get to this point, and quite frankly, retirement is supposed to be relaxing and enjoyable. You're supposed to be doing the honey-do list and all those things you've postponed doing during all your working years. So the question then becomes, what do I need to do to create the income stream for myself, if I'm married, my spouse, to ensure that I don't run out of money while I'm working? Because quite frankly, retirement is not supposed to be full of stress and worrying about where the income is going to come from. I don't care what happens with the London well, and I don't care if a bank fails in Cyprus. I want to make sure my income stream is steady and secure and reliable. And we're going to talk about that today with Cal Brown. He is managing partner of Savant Capital Management. They manage over $3 billion. He's the author of When Life Strikes, Weathering Financial Storms. Cal, welcome to The Savvy Investor. How are you doing today?
Pleased to be with you. Just fine, thank you.
So Cal, I mean, retirement planning and income planning specifically it's a different thing in life. People think they can go through life doing the exact same things they did when they were young, trying to figure out how to amass their wealth. But now they're in retirement. It really is a different approach.
Yes, and it's very emotional. It's a very difficult transition.
So from our perspective, we talked about the Monte Carlo simulators and the whole idea of trying to figure out how much money we can create for income during retirement. Explain to us a little bit, how does a Monte Carlo simulator work?
Sure. Actually, the term goes back to World War II. During the development of the atomic bomb, Monte Carlo was the gambling capital of the world before Vegas, and so they were trying to model conditions under uncertain outcomes, and so they came up with a term called stochastic modeling. They nicknamed it Monte Carlo as a code word, and what a gambling casino does is stacks the odds in its favor. And so using Monte Carlo planning correctly, a retiree can stack the odds in their favor so that they will win. Essentially, when you project cash flows into the future, any kind of retirement planner will say, okay, what's your income, Social Security, pension, et cetera, what are your expenses, and what is your investment portfolio, and they will assume an investment return. Well, normally over the years they assumed a static return, 7%, 6, 7, 8, whatever
Right.
it was. Well, we don't know if that was going to be the right one, but we do know it's wrong, because no investment ever does 8% each and every year.
Right.
So what Monte Carlo does is takes an average return and a bell curve or normal distribution, and each year it projects a different investment return for your income and expenses, and so you have a wiggly line going out in the future. Well, then it comes back and does it again. It picks different returns from that model normal distribution, and so it does a second line. It's different from the first. Then it does it 10,000 times. So you get this squiggly line going off into the future. I have a picture of it in my book so people can see that. But it is, the question is, at the end of the second life, husband and wife, is there at least some money still left in the investment portfolio? How many of those 10,000 simulations ended up with a positive number? Well, if it's 9,500 of them, that's a 95% success rate or a probability rate. So the odds are good. If it's 40%, go ahead.
The odds are good that you're
not going to run out of money.
That you're going to have enough money. So basically, I mean, the long and short of it is that the Monte Carlo plans, they take into account the fact that the market goes up and down over time, that you don't get a steady rate of return. And so that if you're sitting down doing planning and you're assuming an 8% rate of return, the fact is the market doesn't return 8%. It's all over the place.
That's going to be wrong.
Right.
And Monte Carlo isn't perfect. It's just a tool.
Statistics.
It's a good tool.
Right.
It's a decision-making tool. And we don't do it once and then forget about it.
Right.
We do it repeatedly. During 2008, during a downturn, we tried to do, as many of our clients tried to rerun their numbers to make sure that the probabilities were still good. If they weren't, then we had to make some corrections.
Okay, so now somebody has decided they're ready to retire. They're looking at the basic, I've done a budget of sorts. I've tried to figure out what my needs are, and they need to look at everything from, what they need to cover household expenses, personal expenses, whether it's, animals, travel, whatever they think they have to have during retirement. And I always like to look at it from the perspective of there's things that you want, which are the extras in life, and there's things that you need to have, like a roof over your head and food on your table, your health. So for most people, there's a couple different streams of income that are already coming in to cover the must-have.
Right.
If you're fortunate, you have a pension and Social Security. And then for the remainder, that portion of the puzzle, it has to come from the savings. You've saved in your 401k and your brokerage accounts and your IRAs and stuff. And there's a couple different approaches to retirement income.
Right.
Now, for some people, they do systematic withdrawals, and there's pros and cons to that. And so some people, they use preferred stocks and dividend-paying stocks. Some people use annuities. There's all sorts of variations on how to do this. Now, one of the variations is taking I guess, I'm going to call it a more holistic approach to the planning process, to the investment process.
Right.
And it's more of a total return. We're not looking for the growth necessarily. We want to know what the whole portfolio is going to do. And that's kind of the approach you guys take.
Right, and let me explain that by first explaining the income-only portfolio. This is where you say, okay, I've got X amount of dollars, 500,000, $1 million, if you're fortunate, $2 million, and what yield can I get from bonds, CDs, other instruments,
Right.
REITs, real estate investment trusts, and you say, okay, I can get 4%, 5%. Well, that's going to dictate how much money you leave the principal alone and you just take out the income. Well, there are many problems with that, but a total return says let's look at the income plus the growth, plus the capital appreciation, or in some years a loss. So it's total return, income plus or minus capital appreciation.
So let's go back to the income side of it, because I have clients come in all the time and say, look, I can buy bonds or preferreds or dividends, and they're paying 3%, 4%, 5%. Why wouldn't I just put all my money in those? And the fact is the problem with that is that 2008 is a prime example. Preferred stocks stopped paying dividends,
Right.
and dividend stocks stopped paying dividends, and even now we're just seeing the dividends come back into the 3% and 4% range, where in the mid 2000s we saw them in the 5% and 6%.
Right.
So clearly, taking a pay cut,
Yeah.
you would take a pay cut following
Right.
that approach.
The key thing, things change.
Right.
Life changes, your situation changes, you're going to need a new car at some point. It's difficult to have a steady stream of income that never changes from year to year, and your expenses are going to change. My guess is gasoline prices are going to be higher in the future. Medical expenses for a retiree are going to be higher in the future. You might need a new car. If you don't, you're going to have higher maintenance expenses on your car. So you have to be flexible and prepare for change.
Right. It can't be a static approach.
And, CD yields. There actually was a time when they yielded 9, 10%. They don't anymore.
Right.
Bond yields used to be in the low double digits and high single digits. They're not there anymore. Things change. So if you rely strictly on a yield approach, you have a declining income when what you need and want is an increasing income over time.
So that then the total return approach, it's looking at both aspects of it. We're investing part of the portfolio to some extent for income purposes, but we're also investing a portion of the portfolio for the growth. And between the two of them, in theory, we cover the needs that we have today, inflationary pressures, taxes, and for those extras in life.
Right, and this is not some new theory that we dreamed up.
No, absolutely not.
This is actually founded in trust litigation and state laws and legal opinions. Going back to the 1830s, there was a case, Harvard University versus Amory, who was the trustee of a trust. A trustee has to manage for two parties, the income beneficiary for his or her lifetime, and then the remainder beneficiaries after that person dies. Say it's the wife, she's the income beneficiary, and the children are the remainder beneficiaries. What does the wife want? What does the income beneficiary want? Income that's increasing over the years, maximum income. What do the beneficiaries want? Maximum growth.
They want the money.
So the trustee has a conflict. He has
Right.
two competing objectives, and if he doesn't do it well or correctly, he gets sued, and that's where these court cases came from. So over the years, from the Civil War through the Great Depression, they actually came out with legal lists of investments, mortgages, bank savings accounts, safe things that paid an interest rate. That was what trustees had to use. Well, that quickly became apparent based on our discussion about the fallacies or the shortcomings of an income portfolio, that wasn't working, especially for the remainder beneficiaries,
Right.
especially during inflation. So as modern portfolio theory took hold in the 1950s and the 70s and then won a Nobel Prize in 1990, they used the concept of asset allocation and rebalancing in conjunction with these trustees' responsibilities, and they said this is a better way to do it. And so the third restatement of trusts, the Uniform Principal Income Act, which most states have adopted, mandate that trustees diversify, that they use a total return approach, that they minimize costs, and they use prudent decisions in the process in developing an investment portfolio.
But conceptually, that's where the background comes from. But really, the fact that it's founded in trust laws is irrelevant in today's society, because really, given the fact of what the economy looks like, given the fact of the longevity for people nowadays, how many years we're going to be in retirement, you really do need an approach that accomplishes both the income needs of today, but we need growth for future income needs in the future, right? So it's not just because there's a legal obligation, but there's a sound investment approach behind it.
Yes.
We're going to take a quick break. When we come back, we're going to continue our conversation with Cal Brown about income planning, and we're going to delve a little bit more into how total return planning actually works. You're watching The Savvy Investor. We'll be right back. Welcome back to The Savvy Investor. Today we're talking about retirement income planning, and there's several different approaches a retiree can take to creating income streams during retirement. For some retirees, they use annuities with guaranteed living benefits. Other retirees use immediate annuities. Some retirees even use preferred stocks and dividend-paying stocks or systematic withdrawals. But today we're really focusing on a total return approach, and we have Cal Brown. He's a managing partner with Savant Capital Management, over $3 billion under management, and a great book called When Life Strikes, Weathering Financial Storms. And we're going to approach this from how to make sure you have income not only for you and your spouse, but how to do so in a rising interest rate, rising inflationary pressures, rising tax environment. Because really looking at the income I need today and looking at the income I'm going to need in the future is an important part of any type of financial planning. Now, before we get there, Cal, we always take some viewer mail, and we have a couple things coming up here. Susan from Vacaville, she said she lost 35% in 2008, and her advisor said stop taking money out of her investments to allow it to recoup. And she wants to know how she can survive like that, taking a pay cut like that. And this is kind of what I talked about earlier, is that when you take systematic withdrawals, if the market drops huge, you could be forced to take more and more of your assets out to create the same income stream. And her advisor's approach is to, stop taking money.
Mm-hmm. Well, I think that two thoughts come to mind. First of all, what is the asset allocation? To lose that much in that year tells me there's too much in equities in the overall allocation.
So maybe too risky for her needs, given the fact she's in retirement.
And the second thought is time horizon. If you just look at 1 year, that's very, very myopic. You have to take a longer term approach to things. For example, if I had known back then that the market was going to double since March of '09, that's 4 years ago, well, you'd have left it in and just kept on going.
And wrote it out.
Right.
But in the meantime, her concern is that he was telling her to stop taking money because evidently, and I'm guessing like you are, that they must have made some changes to maybe become, because a lot of investors, when the market crashed, instead of, they wrote it all the way down like the average investor does, and then got out. I assume Susan probably did something similar to that. But I guess the real issue is that it's the approach that they took.
Right. And I think the right way to look at it is not the perfect sustainable withdrawal rate, but approach it, what's my initial withdrawal rate going to be? That'll help with those sequence of returns that you were talking about earlier. If you start out and the market goes down right after you retire, you start out with a careful, cautious initial rate of withdrawal, but then as time goes on, then you can make adjustments and incorporate into that plan with the Monte Carlo planning we talked about earlier. Otherwise, you're just you're just adrift and not really knowing what to do.
And unfortunately, it seems to me at this point for Susan that she is kind of stuck between a rock and a hard place. I'm not sure that, going back and at this point without knowing more facts and details about the portfolio, going back and saying, here's how you're going to create the same amount of income, especially if you lost 35%, you might be in a quandary where you really do have to reconsider what your income needs are going to be at this point.
Sure. I thought of an analogy driving up here from Northern Virginia. I started out slow, then I got to a point where I could put it on cruise control, and it was just going great. Then I saw a sign on the Washington Beltway said, crash on the inner loop, so I corrected my course. I went a different way and got back on cruise control, and I avoided the crash and kept on. But then as I got to my destination, I got a little cautious again, and so you make adjustments. When you're driving, you don't just hold your steering wheel like this, you make constant corrections on the way. And I think that's how you should start out retirement income planning, with an initial withdrawal rate that you know is going to change, and be flexible enough to make changes up or down as necessary.
Let's go to Gail in D.C. Now, Gail says that she has access to preferred paying stocks yielding 4 to 7%, and she wants to know, why doesn't she 4 to 7% is not a bad rate of return. Why wouldn't she just put her entire portfolio at a 4 to 7% yield?
Okay, good question.
And that kind of goes back, you
Right.
alluded to that earlier.
Yep. First of all, things change. They're not always going to be 4 to 7%.
2008, they stopped.
Right, just like bonds, they can be called.
Right.
In other words, refinance. Most of the preferred stocks are issued by financial sector companies, banks, insurance companies. That's why in 2008 they were in trouble. So there's not diversification. We went back, we got this question a lot also in our firm, and we looked at it from 2003 to the end of 2012. Preferred stocks had a lower rate of return and higher risk than a 100% S&P 500 index, and even more so than a 60-40, 60% stocks, 40% bonds. It had about the same return as intermediate bonds, but a lot more risk. So you're not getting the benefit of either higher return or lower risk using preferred stocks.
And quite frankly, it is just about the yield. There is very little opportunity for growth.
Right.
I mean, you might catch a little bit on a premium, but very little opportunity for growth. So to me, Gail, if you're looking for income, having preferreds in your portfolio as part of a diversified portfolio to create part of that income stream may make sense.
Right.
But as a whole portfolio of nothing but preferreds, I'm not sure that I would ever advise that.
Just like you don't want to put your whole portfolio into gold.
Exactly. Although I did have clients say, why aren't we all in gold in 2008 and 9? So now let's turn back to the idea of creating income using a total return approach. We understand that we're looking at both sides of the equation, where we're trying to produce some income and some growth. But how might that look? You mentioned 60-40 on equity to fixed. Is that a type of approach you might take?
Let me use a simple pie chart illustration of an asset allocation. Let's say we have 40% in bonds, 40% in stocks, and 20% in an alternative like real estate investment trusts, REITs, which pay a nice yield. So we have 40% bonds, 40% stocks, 20% in REITs. In any given year, one of those asset categories is going to do better than the other two.
Given.
And so in that year, which let's say the bonds did better in whatever year it was, we take our withdrawal for our income needs out of the bond side. Some principal, some income, we don't care. And then if it's still...
I'm trying to keep the principal intact as much as possible.
And we're still trying to keep the 40-40-20 relationship. So even after we've taken our withdrawal, if it's out of that 40-40-20 relationship, we will sell something from something else that did well, sell high, and redeploy that into something that didn't buy low.
That's an interesting concept.
It's brand new.
Sell high,
brand new with us.
buy low.
You heard it first on the
Wow.
Savvy Investor.
Look at that, folks. What an incredible tip. Yes, absolutely.
So the next year, stocks do better. And so we take our withdrawal from the stocks, and then we rebalance, get back to that 40-40-20. The next year, REITs do better, so we take it from REITs. And so it's this constant correction and adjusting, rebalancing, and I will tell you this is very difficult to do mechanically, and it's difficult to do emotionally.
I would think the emotional part is the hardest from the investor side of point.
Right.
I mean, for us as managers and advisors, it's much easier for us to be objective and just kind of rational. Here's the rule, we follow the rule. But for the investor, it is difficult, and especially, you know, from my perspective, one of the things that just drives me crazy is, again, those big box stores always constantly buy and hold, buy and hold, buy and hold, buy stock, buy stock, buy stock. And it seems to me that the approach that you're talking about here, for the right investor, it makes perfect sense. You know, to be able to create the income, and you're picking and choosing the sources of the income based on the best overall return, keeping the portfolio balanced for risk, balanced for return, and designed to create the income stream that they're going to need for retirement.
But in conjunction with that, the asset allocation and the rebalancing, you also periodically, every 2, 3, 5 years, run that Monte Carlo analysis on your income and expenses again, and just make sure that you're on track and on course and not veering off into a ditch somewhere.
So there's more than one approach to creating this retirement income. And quite frequently, when you go to an advisory firm, they have one size fits all. And one of the nice things I liked about Cal's book, one of the nice things about Cal's approach, is that it is not a one size fits all approach. Each individual investor has a different need and a different approach and a different comfort level. And so when you sit down with an advisor, if all they espout is annuities or preferred stocks or dividend, you need to really take a look at what fits for you, what's the philosophy of the firm, to make sure there's a good fit. Now, we're going to take a break here. When we come back, we're going to talk about the key takeaways that Cal has given us today. You're watching The Savvy Investor, and we'll be right back.
Now keep in mind that just like any tool, there's the right tool for the right job and a wrong tool for the wrong job. We've just scratched the surface here, and you'll want to know more about how today's conversation might or might not fit your needs. Ask about fees, surrender charges, market risk, interest rate risks, how the guarantees work, liquidity, and much more. Remember, the right tool for the right job.
Welcome back to The Savvy Investor. Today we were talking about retirement income planning with Cal Brown, Managing Director of Savant Capital Management with over $3 billion under management. And he gave us 3 takeaways today that we all want to pay attention to. First, he said, listen, you need to establish reasonable expectations for your income needs. You need to modify them and adjust them for inflation and taxes looking forward. Second, he said, take the least amount of risk possible to accomplish your income goals. Kind of a sleep well at night approach. Basically, you want to look at the investments you need to have in order to create the income, and you want to basically take the least amount of risk possible to create that income stream during retirement. And finally, he said, diversification is important. He said, you need to make sure that you diversify your income sources to make sure they're all safe, secure, predictable, and reliable. And if you would like our step-by-step guide to retirement income planning, give us a call and we will send this out to you at no cost and no obligation. It's our step-by-step guide to retirement income planning. You've been watching The Savvy Investor. We'll see you next week.